Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we're going to take a look at where investors can find income-paying assets. Since Britain's vote to leave the European Union, the Bank of England has taken drastic steps to boost the UK economy. Interest rates have been cut for the first time in more than 7 years to a new low of 0.25%. What do you think of the interest rate cut? We took to the streets to talk to savers and borrowers alike to ask whether they will be spending more now rates are even lower.
With Bank of England cutting interest rate to 0.25%, what do you think about it?
Well, good. As a homeowner with mortgage, yeah, great, good news. We've got mortgage renew coming up end of the year, so yeah, fantastic. Obviously, savings-wise, not so good, but I think for homeowners, I think the pros outweigh the cons.
Well, as I'm a saver, not a lot really, but something that happens. When we had a mortgage, it was a high interest rate, now it's a low, and that's just not a lot you can do about it really.
I think they should have interest at 0%.
I'm not sure it'll make a great deal of difference, to be honest. It appears to be there just to instill confidence, but 0.25%, most of industry isn't materially different.
I think it reflects where we are as an economy at the moment, and I think they're going to have to go up again at some point in time.
I don't think rates should be as low as they are. I think it creates a lot of malinvestment in the economy, and I think they need to reassess how they their monetary policy, and yeah, I don't think it's necessary.
I think as long as you have ambition and you want to earn a lot, then you shouldn't always look at what interest the bank's going to give you.
For me personally, it just means I just put money in a current account and leave it there. I don't bother with anything at the moment.
My uncle is a mortgage broker, and he tells me that although the rate cut might have a longer term effect, at the moment it's not really affecting the rate at which people are buying houses and his business.
So will you want to save more or spend more because of the low interest rate?
Well, to me, it doesn't really make a personal difference to myself. I mean, I don't have any interest-bearing debt, or I don't get any interest from my investment. So to me personally, it doesn't make any difference.
Well, I don't think you can spend too much because you've got to have some kind of savings, haven't you? Just put it in my mattress under my bed, probably. That's the best thing.
Obviously, if the rates are going down, I might potentially save less. But like I said, I'm not a massive saver. Is it gonna have an effect short term? I don't think so in terms of actual saving rates.
I'm so bad at saving anyway. I'm so bad. Like, I'm not going to be saving. I'm probably going to stay the same. I'm probably going to spend way too much.
All the money I earn, I spend on travel and rent. I don't really have any capacity to save money. I'd like to be able to save more, but it's not really a reality.
I'd like to save more, but it's not worth it at the moment.
I think people might be inclined to buy property because it's given them a feeling of a longer term sort of like lower interest rate. So it might do that. I think there are better ways of saving than to put your money into cash anyway. So if you look around at shares or any other vehicle, it's much better than cash. I don't think anybody's in cash at the moment.
Even save more, because I think there's something wrong. Yeah, it doesn't make me spend more, no.
So how can you save if it is a bit lower interest? So it's instead of you to save here, you can save your money in some other countries.
There's sort of no point to saving really at the moment. Whereas, a few years ago, worth putting if you've got a few grand into a savings account to get that extra bit of. But yeah, there's, I suppose now just seeing that's at disposable income, it's more likely to be spent than going into a savings account. Yeah, mortgage-wise, yeah, definitely. I think that's where that's where I see the biggest benefit being for me. Yeah, just lower monthly repayments on there and easier fixed rate mortgages and everything like that. Yeah, it's a good time to be a homeowner where the rates are. Yeah.
It being less to buy a house is probably more important because it's very hard for the younger generation to purchase a building.
When I was looking at my first mortgage, I had to look at 18% mortgage interest rates. So from my perspective, 1/4 or 0.5% makes no difference. It's immaterial. You still need to protect yourself against 5 or 10% interest rates. That's the real difference.
Do you want your investments to pay you a regular income? Up next, we ask Investec's John Stopford how to blend income-paying assets for a sustainable yield.
Hello, John.
Morning.
So we're doing a back to basics week this week, and we're looking at investment education. You're an income manager, and income is something that investors really want. It's difficult to find in current markets, but I thought we could start by talking about the types of assets that provide investors with an income.
Okay, great. So income investing, as the name suggests, isn't restricted to a single asset class, although inevitably, historically, it's been fairly focused on fixed income, on bonds. So a large proportion of the income universe includes things like government bonds, investment grade corporate bonds, high yielding corporate bonds, emerging market debt and so on. But a lot of those assets clearly have become quite low yielding, courtesy of central banks, slower growth, lower inflation and so on. And so investors are inevitably forced to look further afield for income. And so equity, which has been an income area for a long time, has become obviously an important component, but also property, and then more niche areas like listed infrastructure and so on. So the income universe is incredibly broad, and it's all about trying to find trade-offs. It's about trying to find an attractive trade-off between the yield you can earn, but also the potential for capital growth and also the risk that you take with that. And a lot of the higher yielding areas are somewhat riskier. So trying to balance risk and yield and return is essentially what we're trying to do.
And as the name suggests, and as you've alluded to there, diversified income means that you're looking for those income within those different pockets. How do you blend income assets for that maximum income payment with the sort of managed risk at the moment?
Well, I think it's very important to have a clear objective, so to know what you're trying to do. So, there are lots of different styles of income investing. Some people are focused much more on trying to chase capital growth with a bit of income. We're very much at the defensive end of the spectrum. So our primary objective is to deliver a defensive total return. So not just income, but scope for capital stability, capital growth with low volatility, and ideally low drawdown characteristics. And so we're looking for a much more defensive outcome, but still paying an attractive but sustainable level of yield. So the kind of things we're trying to do, the first is actually with the advantage of having all of this choice, is rather than building a portfolio of lumpy blocks of assets, actually picking individual securities which can help us meet those objectives. So assets that have attractive yields, but also where those yields can be maintained or potentially grow, where they're well priced, where they're supported by the economic environment and so on. And then in terms of diversification, as you say, it's very important, I think, to try and blend assets that have different characteristics together. The danger is you go and seek yield, and first of all you chase things that are unsustainable, so companies like Tesco's or Barclays, for example, recently, where dividend yield looked very high, but it was because the company was in trouble and ultimately we're going to cut its dividend, so that's clearly not sustainable. But also if you're going for a lot of the high yielding assets like property, like high yield, to some extent like equity, they all tend to be very cyclical. So if the economy is doing well, they do fine. If the economy does badly, they do badly. So you need to blend those assets or those investments with securities with different characteristics. So things like government bonds that are perhaps more defensive, or listed infrastructure, which is more of a diversifier, and so on, and end up with a portfolio that has a blend of risks. So when some things are doing well, other things may be doing less well, but they're tending to offset each other and lower the overall volatility for the return that you get.
And how has that blend changed over time? Because as you said in your first answer, we've had this environment where bond yields have been pushed ever lower. Not that long ago, you could get on a sort of less risky asset a 5% bond yield. That's just not the case anymore.
That's true, but I think the advantage of looking at the portfolio from the bottom up, so looking at individual assets rather than blocks of assets, is typically within any asset class you can find more attractively valued, good quality assets that you can own. So the overall yield on government bonds has clearly come down, but we think there are areas within the market that are supported by ongoing central bank easing that still pay a reasonable yield within the context of government bonds. It's all about making sure that you take full advantage of the breadth of choice that you have, and then be flexible. So as opportunities arise, take advantage of them. So earlier this year, high yield bonds, high yield corporate bonds had sold off very dramatically as people were worried about the collapse in oil prices impacting particularly the energy sector in the US, but the whole US high yield market sold off, and that created opportunities to pick up good quality businesses at decent yields. Similarly, for a lot of the last couple of years, emerging markets have been somewhere that people have avoided, and that's meant that some of the better quality markets there actually now look quite attractive. Interest rates are starting to come down, inflation's falling, so government bonds in places like Indonesia we think are reasonably attractive on a hedge basis. It's all about trying to balance yield, risk and return.
John, thank you very much.
Pleasure.
How should you invest after you have retired? Your investment income and growth requirements are different once you've stopped earning your regular wage. Anthony Gillham, co-head of multi-asset for Old Mutual, is up next to discuss this issue.
Hi Anthony.
Hi Emma.
So we are running a back to basics week this week, and we're focusing on retirement today. And that ties in with a fund range that you run, and it's looking at how to build a portfolio for retirement, in retirement. How does one go about that?
Yeah, that's right, Emma. Yeah, actually, I think it's an interesting challenge. And you know, when rebuilding those portfolios last year, a lot of the market research that we've done and some of the work with advisors actually indicated that whilst there are a lot of investment solutions out there that have been designed for customers who are actually accumulating money for their retirement, there's actually very little out there to help customers who want to remain invested in retirement but draw an income from their retirement savings. So we spent quite a lot of time working with advisors really just to understand what are the, I suppose, most important or kind of the key characteristics that investors expect. And I think there's broadly three things that we're looking to do. The first is flexibility. So very interestingly, the generation portfolios that we've designed, they don't target a specific level of income. Actually, what we're trying to do is, by defending on the downside, guard against this so-called sharp market drawdowns, and actually allow clients, instead of just relying on taking an income, which is quite flexible actually, to be able to withdraw from portfolios whatever their income need might be. So we're looking to defend on the downside. The other risk that we're looking to mitigate, I suppose, for clients who are looking to take retirement savings or take a retirement income rather from retirement savings is, of course, inflation. Inflation's running quite low at the moment, but there are some nascent signs that inflation is picking up, and so what we're trying to do is to put together a diversified blend of different types of assets, so company shares, corporate bonds, but also real assets, so infrastructure assets, for example, that aim to guard against the effects of inflation that over a 20 or 25-year retirement period actually might eat quite substantially into the ability of a retirement portfolio to generate that income.
And income is what everyone wants in retirement, but it's no mean feat finding income in this current market environment. The Bank of England has just dropped interest rates for the first time in 7.5 years, 0.25%. Bond yields have come down. Some equity players, which previously were paying out very healthy dividends, have been hit by share market losses and so therefore are no longer paying dividends. So where do you find that sustainable, flexible level of income for those people in retirement?
Well, I think being a multi-asset investor really helps with that, actually. Of course, being a multi-asset investor means we can pick from across different asset classes. So whether it's company shares, whether it's corporate bonds, whether it's even cash, actually, that's certainly an investable asset for us. And so by tilting the portfolio to, I guess, where we see the most attractive risk-adjusted returns, I think we can continue to meet those objectives that clients have. Now, you mentioned the Bank of England recently cutting interest rates, extending its quantitative easing programme, actually extending its quantitative easing, its money printing programme, actually further than just government bonds, but into corporate bonds as well. Well, actually, corporate bonds is an area that we've been favouring really over the past, I'd say, 9 to 12 months, really emphasising those types of investments in our portfolio. And of course, as particularly in the US, actually, it was an interesting interesting example. Last year, a lot of the market in the US actually had a little bit of a torrid time as yields started to rise in the US on the back of the energy crisis. So a lot of corporates running into a little trouble as the oil price fell quite sharply last year. That actually prompted a number of investors, actually quite a lot of investors in the US, to withdraw their money from the asset class. And of course, it's this classic supply-demand thing. There's too much supply and not enough demand. Well, the price goes down. Well, that's an opportunity for investors such as ourselves. And we've been emphasising that corporate area of the market. And I think there's still actually some quite risk-adjusted, quite attractive risk-adjusted yields. Now, of course, in an environment where you've got quite attractive risk-adjusted yields in corporate credit, particularly in the US, but by the same token, you've got central banks continuing to print money, continuing to cut interest rates. Well, that really opens up the opportunity for that asset class to really perform quite well. And certainly we've seen that over the last 9 to 12 months, and certainly since the bank's decision back in August, we've seen some really good performance from corporate credit.
Anthony, thank you very much.
Thank you.
Bricks and mortar property funds can have liquidity problems, but investing in property stocks don't carry the same risks. Alex Ross, manager of the premier Pan-European Property Share Fund, explains how European property stocks are offering income opportunities.
Hi, Alex.
Hi, Ma.
So, property's been in the headlines over the last couple of months, property funds, because some bricks and mortar funds were forced to close their doors to new trades, to new money, and indeed to redemptions following Brexit concerns. Now, your fund's slightly different. It's property equities, property shares. But is Brexit still a concern for you?
Yes, so obviously Brexit's had an impact on the real estate market, as you say, with various issues with the open-ended funds. But one of the benefits we have of investing in real estate securities is liquidity. And whereas we're quite a volatile fund in terms we have a high correlation to equities, we do have good levels of liquidity by investing in companies that are listed on the stock market, which are therefore reasonably liquid.
And is there any contagion risk there? People see property and they get scared, or, as you say, because it's an equity fund, actually you're a little bit removed from that?
Yeah, certainly we had a knee-jerk reaction on the real estate securities market post-Brexit. So we saw a lot of weakness in listed property companies. And I think there's some justification in some of the weakness in terms of, I think there's areas of the property market which have been fundamentally negatively impacted by Brexit in terms of sentiment on, for example, London offices. There's uncertainty about the plans of that tenant market, and also the potential supply of buildings come online in London. But we think ultimately the fundamentals of real estate should come through. And the key fundamental attraction today of real estate is really why you should be looking at property in the first place would be for its income yield. And we think the income yield on real estate today on a relative basis is attractive.
And of course, income is incredibly hard to find in this market where bond yields are being squeezed ever more. Of course, the other thing about your fund is it is European. It's not just exposed to that UK property market. Are you seeing greater opportunities then in that European section?
Yeah, so we've seen a very different market in Europe in recent months. So whereas the UK has been clearly negatively impacted in terms of sentiment post-Brexit, and on the continent probably almost been a slight beneficiary of what's happening in Brexit in terms of what's happening on the continent is the yields available to investors on alternative asset classes, such as, for example, bonds, have reduced significantly. And what that's ultimately done is reflected the attraction of alternative bond-like income. And we think the bond-like income you can get from well-let real estate in areas like Germany, in France, in Sweden, for example, we think that income is increasingly attractive relative to what is available to, for example, institutional investors elsewhere.
And how sustainable is that yield? Because there's a lot of pressure on other equity income stocks about how sustainable the yield is, just simply because equity prices have come down. But I suppose with property, you do get a bit of visibility about that income stream.
Yeah, I think that's a very valid point. So one of the key things we're looking for, there's a reason why bond yields are low and why there's very low inflation. It's because there's weak economic growth. And therefore, you have to really look carefully at the strength of the income stream and how sustainable that income stream is. So what we're trying to focus on is those areas of the property market, and commercial property mainly, but also residential, in, for example, Germany, is where you have sustainable income. And what we mean by sustainable income is where there's property that's well let to good quality tenants and where those rents are also affordable. And we think that where that income is at least sustainable, we think there's a reasonable outlook in terms of the attraction of that yield.
Alex, thank you very much.
Thank you.
Up next, our guest Tom Walker, manager of the Martin Curie Global Portfolio Trust, explains his unconcern with high valuations in US equities, saying that the strong economy and poor returns elsewhere actually make US stocks a compelling investment.
Hi, Tom.
Hi, Emma.
So global by name and global by nature when it comes to revenues, but when you're looking at listings, a sizable proportion of the portfolio is in the US, around 60%. And this is a region that people are quite divided over. A lot of people are saying US overvalued, time to sell up. How do you feel about that?
Well, two things. I think on valuation, I think one has to think in relative terms. We are, unprecedented is a much overused word, but we are in unprecedented times. We've got negative interest rates in a number of European countries and Japan. We've got very low interest rates almost everywhere. And, when the UK government is paying you 60 pence or so per annum for 10 years if you lend its money, you've really got to rethink valuation. So if I can find a company that's giving me, say, 10% earnings growth, trading on 20 times next year's earnings, I actually think that's really attractive. A company that's growing its earnings, growing its dividend, creating value for shareholders in this low growth, low interest rate environment, that's very attractive. And there are certainly lots of companies of that nature in the US. And as far as economic growth is concerned, it is patchy, and I'm not a bull of global economic growth. I think the US economy is only going to grow modestly. I don't actually think the Fed's going to put interest rates up much in the foreseeable future. But there's always a niche where there is growth. So whether in the US you're looking at investing in technology in California, smartphones, digital media, online retail, or if you're looking at other parts of the world in Asia, if you're looking at developing consumer markets in growing middle classes in less developed economies, there's always areas that are growing more rapidly. We're certainly in an environment where the tide is not rising. All boats will not be lifted. But by being selective in global equities, including in the US, I think there's really good value to be had.
And we're running an education week this week, so it's worth highlighting that although, as you've spoken about before in the past, you have companies that are listed in the US, they're not necessarily US in nature, are they?
No, I mean, if you look at a lot of large US companies, they're very much global earners. So whether it's Apple selling phones in China or a company like Visa, the payment processing company, where about a third of its earnings in the US, a third in Europe and a third in the rest of the world. So, and a lot of the large cap companies that I invest in are very much global earners. A lot of their marginal growth is coming from emerging markets because that's where there is more growth. A lot of their core earnings and strong positive cash flow is coming from the more developed markets, particularly America, but also Europe. But they are, generally speaking, global earners, whether they're quoted in the US, Europe, wherever.
And you are looking at companies that are both listed in the emerging markets and have revenues in emerging markets as well, don't you? This is not simply a US story.
No. I mean, I think there's scope to invest selectively. I used to manage a China country fund, funnily enough, so I'm a little bit wary of corporate governance and some other issues in some emerging markets. It's getting better, but I think sometimes the best way to get exposure to emerging market economic growth and earnings growth is through developed world quoted companies. But yes, we're invested in Indonesian companies with good management, where their earnings are almost exclusively coming from Indonesia, and very comfortable with that if we can find the right companies.
Tom, thank you very much.
Thank you.
Investors should ignore news about Brexit and Donald Trump when making investment decisions. Bronze-rated Crux European Special Situations Fund Manager Richard Peace urges investors to ignore politics and focus on individual stocks.
Hi, Richard.
Hello.
So Europe has fallen off the radar a little bit because Brexit in the UK and the US elections across the pond have taken their headlines, but there is a lot going on across the continent. One of the things that we are concerned about is this sort of contagion with the movement in the US and the UK, this anti-politics politics. Should we be concerned about the continent?
Well, I think one has to be a bit concerned that Brexit might be the first of the dominoes. And certainly as far as the US elections, I think the market's concern is that if Trump should get in, that he'll be very protectionist. I like to think that obviously he has been successful from a business point of view, and hopefully he won't do some of the things that he's promised if he actually gets in. I hope he's not that stupid. So I guess that it does concern the market, but hopefully the worst won't come to pass. From our point of view, as always, we try and focus on individual stocks rather than crystal ball gaze the macro, and that does tend to add value, and it does tend to protect us in terms of our sort of longer term outlook.
I suppose the macro, though, does create opportunities for you to add to positions that you do like. Markets across the board in Europe are down 2% today, perhaps because of the concerns across the pond with Hillary Clinton's health and the likelihood of Trump getting into the White House. You say you don't make decisions based on the macro, but presumably when there is a bit of volatility, you can add to those positions you feel strong about.
Yes, we do. I mean, I think that's exactly the way to put it. I mean, I think if you kind of follow stocks very closely, you are sufficiently confident to buy when the market's nervous, and that definitely helps.
I suppose one of the other things that is a potential headwind for the European stock market is this Italian banking crisis. You know, those stocks in themselves fell, but also the contagion risk across financials and indeed across other equities. It has had some effect, hasn't it?
Yeah, it has. I mean, I think if you look at it very simplistically, the southern European economies benefited the most with the European Union and low rates. And I guess if you reverse that, they suffer the most. And obviously banks are the ultimate leverage play on that. We aren't actually in southern Europe particularly at all, and we're certainly not in southern European banks. But certainly I think the market is probably quite right to be a bit concerned about that.
You do have some exposure to financials, though, don't you?
Yes, we do. It's much more Scandinavian-based. We have 3 Scandinavian banks. I mean, that's a slightly special situation, story, where we feel the dividends are very likely to be paid. There's decent yields and decent management. So it's not a sort of global story.
And where are you seeing the best investment opportunities then? Is it very much a case by case because of the special situations nature of the fund? Or are there particular pockets because of the place in the cycle that we're at that you're seeing sort of thematic opportunities?
Well, I guess what we tend to do is we look at stock by stock approach, but that very often ends up with us having a bit of a thematic idea or two. And one of the ideas would be, I still think, outsourcing. We've got quite a lot in caterers and that kind of thing. The attraction of that sector is that, interestingly, when the economy is trickier, people are encouraged to outsource because it saves money. So you can see it's sort of easier to get business, and there's lots of sort of self-help you can do. And I think the other attraction with that kind of business model is that you have a lot of recurring revenue, and certainty is obviously very much appreciated in uncertain times. And you have negative working capital. And I think that the very fact that these sorts of companies, in quite a few cases, have been through private equity and been very leveraged, and now they're public and in most cases very deleveraged, tells you that the business quality is actually very much there. Otherwise, they couldn't have got the leverage. So we do like some names there.
And over the last 12 months, you've managed a 25% return to investors, which is pretty good, especially compared to some peers. The way that you were positioned over the last year, do you expect that to continue to deliver, double-digit returns over the last year, or was that a next year, or was that a sort of a unique 12 months?
Well, I mean, I would be foolish to try and make a promise, but I think, I mean, our approach has been pretty long-term, and so we don't tend to change the portfolio enormously. We've certainly made some changes, and we've taken a few profits, but essentially the portfolio is pretty similar in terms of its actual sort of principles, and a lot of the same names are there. I think quite a lot of that 25%, being frank about it, is sterling's weakness. I mean, I guess sterling's recovered a bit, but it's probably 13-14% down against the euro. So we've had a big helping hand just in terms of currency there. I mean, I would hate to make silly promises about expected returns, but I think that if people can mentally turn off that screen and actually invest rather than just speculate, I think certainly history will be on their side. I mean, I think certainly if you look at our strategy, it's been fairly consistent in terms of delivering over the 3 to 5 year period. I would hate to make a short-term promise there.
Richard, thank you very much.
Thank you.
The Bank of England may have chosen to keep rates at 0.25% earlier this month, but there may be further cuts to come as Britain's economy digests the impact of Brexit. Could interest rates be cut again in November? Alexis Gray, European economist for Fidelity, is up next to discuss.
Hi, Alexis.
Hi.
So yesterday we heard from the Bank of England that the MPC had made the decision to hold rates in September. However, a closer inspection of the minutes show that they will possibly be cutting rates in November. We've had positive economic data since Brexit, so why would they be considering a rate cut in November?
Well, I certainly think it's true, Emma, that in the last few weeks that the economic data for the UK has been better than expected. But let's put this into context. I think after the Leave vote, it's clear that this Brexit story has had a negative impact and that the UK has headed into a sharp downturn. Now, whether or not that's going to be an outright recession remains to be seen. But I think given the position that the economy is in now, which is quite soft, it's prudent that the Bank of England has done such a big stimulus and is leaving on the table the possibility of a rate cut. In fact, what they said yesterday was that at the November meeting, if we continue to see soft data, that there's likely to be a policy cut. So we'll get interest rates dropping close to zero. I don't think it's clear, though, whether we're going to get further quantitative easing, but a policy cut seems more likely than not.
And one of the things that we have seen on the ground, the impact of Brexit, has been a weaker sterling. And to cut rates further would indeed support that low value of sterling. This has not been positive for UK holidaymakers, but it is actually quite good for the economy, isn't it?
That's true. I think the sharp depreciation in sterling is actually a buffer to the economy when it's going through this sort of soft patch. I mean, I think the effect of Brexit is to raise uncertainty. So right now for a UK business, they're not clear exactly what the relationship will be with the European Union going forward. So what we're seeing is businesses holding off making large investment decisions. And so I think if you see that fall in sterling, it actually raises the competitiveness of local businesses. They're selling to foreigners and now they look a lot cheaper. So that's good news. Now, of course, there's this, upside and downside to a weaker sterling. For a holidaymaker going abroad, it's more expensive, but as I said, it raises the competitiveness of UK businesses. So, I think on the whole it's a good thing.
And of course, yesterday wasn't just the latest MPC meeting, it was also the 8-year anniversary of the collapse of Lehman's, the bank which sort of signalled the beginning of the global recession. Before we had the Brexit vote, there were a lot of people suggesting that should Britain leave the EU, we would actually undo all the growth that we have made as an economy since that global recession. Do you think we're heading in that direction?
Look, I think the collapse of Lehman Brothers was a very significant event, but not really comparable to Brexit. I mean, Brexit is sort of an isolated UK event. So far, we've seen that the negative consequences on the economy have been, for the most part, isolated to the UK. We haven't seen much of an impact in Europe, and certainly in the US and China and other sort of countries further abroad, we're not seeing much of an impact. Now, Lehman collapse was a global recession, a global financial crisis, so much larger event. And I also think with Brexit, we're still early days. So although we know we're going to leave the European Union, we don't actually know how that trade relationship is going to work, whether immigration flows will be cut off. There's two sort of broad pathways we could take, which is a hard break, a hard Brexit, where, as I mentioned, all the trade links and immigration slows down, or a softer Brexit, which is similar to what we have today. But that uncertainty alone, I think, will weigh on the UK economy, but we can't see yet how big this is going to be.
Alexis, thank you very much.
Thank you.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.